Hello and welcome everybody to the channel. Today we're talking about the largest beauty retailer in the United States, Ulta Beauty, ticker symbol ALTA. Ulta has over 1,300 stores in operation across the U.S., with plans to grow their store footprint to around 1,700 stores. However, the company has put plans to expand internationally into Canada and Mexico on hold for the foreseeable future. Despite that, Ulta has seen consistent growth to the top and bottom line while delivering S&P 500 beating returns of over 15% per annum in the last 10 years. The only down year was the COVID year of 2020, yet they bounced right back and continue to grow year over year. That's something we'd love to see as quality investors. It suggests a strong business with a loyal customer base. Ulta does face some headwinds, however. Retail is always a risky industry as customer preferences are fickle, inflation can keep people from buying, and recently, organized theft has decimated retail in general, and even Ulta is not immune from it. Theft is a silent destroyer of returns because it forces companies to write down inventories, put more anti-theft measures in place, and puts the people that work and shop in the stores in danger. Putting in anti-theft measures increases costs with little benefit to the top line, thus hurting margins and ultimately the free cash flow available to investors. Ulta has proven resilient to these and many other pressures, however. It is a recession-proof business proven by the post-COVID bounce back after stores were literally shut down for a year. Customers love their loyalty program, and part of the beauty experience is going to these physical stores to try out cosmetic samples that cannot be replicated online. Ulta also has partnerships with Target, what they call a shop in a shop, over 400 with plans to expand to 800, an in-house beauty salon, and the largest selection of beauty products available anywhere at price points for every budget. The beauty salon, in my opinion, is what sets it apart from the higher end Sephora, its closest competitor, and a quick Twitter X search for Ulta shows tweet after tweet of people spending way more than they wanted on their beauty run. Always a good kind of marketing for the business. Full disclosure, I do not own any of the Ulta stock, and this is not financial advice. All right, let's talk about how we're going to analyze this stock. Starting out on our investment summary page, we see that Ulta Beauty has a market cap of $20.63 billion and is currently trading at a share price of $413.71. Their PE ratio is at a very attractive 16.6 right now, well below their 5 and 10-year averages, and all their other valuation ratios are trading well below their 5 and 10-year averages, something I really like to see. Profitability-wise, their gross margin is at 39%. Their operating margin is at 15%, both below their 5 and 10-year averages. And they have a return on assets of 23%, a return on invested capital of 21%, and an amazing return on capital employed of 43%. Each of which are below their 5-year averages. Ulta does not currently pay a dividend, however, which is a slight knock against them, but with their free cash flow generation, they should be announcing a dividend in the next few years. And they do have a health ratios here of current ratio of 1.7, and they have a debt to equity under 1, something I always like to see. Coming up here and looking at some of their compound annual growth rates, their revenue per share is close to 20% per annum in the last 10 years. They've been increasing their gross margin, decreasing their operating expense margins, I should say. They've really increased their earnings per share. And you can see they have a strong share buyback program as they've reduced their shares outstanding 2% per year over the last 10 years. They also have excellent free cash flow per share growth, nearly 40%. Taking a quick look at their chart, we can see their 1-year chart history here. They have hit some lows here on close to $400 in the beginning of June after they reported less than stellar Q1 results, but they have delivered solid returns over the last 10 years of 304% total with a compound annual growth rate of 15%. Taking a look at their charts here, we can see very consistent and stable growth in virtually every metric for them. Revenue, year-over-year growth, net income growing each year. The earnings per share, you can see that one bad COVID year hit them in 2020, but they bounced back very nicely. And you can see that strong share buyback program reflected in their shares outstanding chart here. Looking at some balance sheet charts here, we can see that their cash has decreased a little bit, but is back on the upswing. but more importantly, their free cash flow has consistently grown over the last 10 years. And that is something we really like to see when we're investing in these types of businesses. Their margins, on the other hand, the gross margin has been pretty flat for the last 10 years, but there's a slight increase you can see here in the net margin, and really nice increase in the free cash flow margin over the last 10 years. Very healthy growth for this company. All right, let's take a quick look at the growth projections I have for Ulta. I am projecting a fiscal year 24 revenue of $11 billion, which will be an 8% increase over their fiscal year 23 revenue. And for growth for the next 10 years, I have a 4.5 in year 2, all the way up to a 6% growth starting year 6 through 10 thereafter. That gives us a 5.88% compound annual growth rate for revenue. For earnings per share, I am projecting 6% in year 2. All the way through year 6, we have a 7% growth rate projected thereafter through year 10, giving us a 7% compound annual growth rate for earnings per share. If we take a look up here at our historical charts, we can see that the earnings per share has grown really nicely at 24.52% for the last 10 years, and revenue at 16.5% over the last 10 years. So my projections are coming in well below what the historical averages are, telling me that I'm still being pretty conservative here with my projections. And if we look at our net income margin, you can see that in year 10 of my projections, I'm looking at a 12.31% net income margin, which in my view is maybe a bit higher than their historical norm here, but I should expect to see a net margin increase as the company expands and solidifies their market position. I'm also projecting net income to grow at about 85% of what the earnings per share grows at. We can see that reflected up here in their historical averages, so I think that's a pretty reasonable assumption. And then on the free cash flow conversion, which is how much cash the business converts to free cash from net income, I estimate that at about 90 cents of every dollar of net income turns into free cash flow. And that gives us a pretty healthy growth here of 5.5% over the next 10 years with free cash flow margins at 11%. So how does that actually affect our discounted cash flow? Well, once we look at our DCF model here, we can see that our free cash flow margin is very in line with our historical amounts here. The last 3 years, they've grown it quite nicely. I have it at 11% in year 10. And using an 8% discount rate, we get an intrinsic value of $27.7 billion for business. That leaves us with a discounted cash flow price of $556 per share, well below their current trading, or well above, I should say, their current trading price of $413. And with a 25% margin of safety, that's a $417.32 buy price. I'll explain why I use a 25% margin of safety shortly. Ulta does not pay a dividend, so we'll skip the dividend discount model. But looking at our exit multiples model here, for competitors, I chose Bath & Body Works, TJX, or TJ Maxx, Ross Stores, and their average PE ratio comes to about 26.45, which is well above what Ulta Beauty's PE ratio currently is at 16.6. And using that average, we get a exit multiples price of $659, and with that 25% margin of safety, a $494 per share buy price. We'll also skip the grams valuation model because it really doesn't apply to this situation. There's certain use cases for grams, and I can go into that in a later video. But looking at our final investment summary here, what do we have? So we have a discounted cash flow buy price of intrinsic value of $556.43 a share. The dividend not included. The exit multiple is $659.09 per share. So that leaves us with a valuation average of $492.92 and 36 cents a share, with a potential upside of 43.18%. That's amazing upside in my opinion. A margin of safety 25% leaves us with an acceptable buy price of $442.27. So why did I select a margin of safety of 25%? Well, Ulta Beauty is in the S&P 500, and generally I give a margin of safety of around 10 to 15% for S&P 500 companies. However, Ulta is in the retail industry. And the retail industry is suffering from bouts of high inflation as well as organized crime, basically theft from their stores. And because of that, I'm giving myself a little bit more breathing room here of 25% for a margin of safety. And even at that margin of safety, we can see that $444 is a very attractive price for this business, especially when the current price is trading at $413. And you have to remember, I'm projecting growth rates here of under 6% for free cash flow, which is well below their free cash flow growth rate historically. So I believe with my very reasonable assumptions and a very bright future for Ulta that this is right now a very attractive company to purchase, and I plan on purchasing some shares today when the market opens. That wraps up our episode today, and thank you everybody for watching. Let me know what you think. Is Ulta Beauty a buy right now at the current trading price? Do anybody out there own shares of Ulta Beauty right now? Let me know what you think in the comments below, and also please hit that like button and don't forget to subscribe to the channel. Happy investing, everybody.